Okay, well, the purpose of today's webinar is to just kind of talk about what's been going on this year, the last 12 months. These webinars are usually inspired by conversations we've had with clients, conversations we've had amongst ourselves. And so we thought we would kind of kick off. I don't know if you want to go on to the next couple of slides and get to like the, yeah, that one. When we were talking amongst ourselves about what we wanted to discuss today, we were just talking about how it's been sort of an emotional couple of years. The market's been very volatile. We've had a lot of, I know I've had a lot of conversations with clients who are nervous or feel like they're lack direction or something of that effect. So we talked about how to remove that sort of that emotional portion of financial strategy and why it's important. We get a lot of questions that kind of seem financial based, but are really more of a feelings based questions. We're going to kind of talk about that. And Amanda's put together a really nice overview of the market, things that we've talked about this year, what's going on. And surprisingly, one of the most exciting topics in this year's market is bonds. So we're going to talk about that some too. Well, I think we have, yeah, they know who we are. You can flip through there. All right, so we're going to talk about one question I'm getting a lot, like a lot, is folks wanting to pay off their house. So I have this conversation all the time, and I'm doing another presentation for my bar association in a couple of weeks, and I thought, well, I'll just use it remote. So we're starting with poll questions this time. And this one is, how would you describe yourself when thinking about your personal finances? We've listed them as nervous, somebody who doesn't like change, it feels very overwhelmed, just doesn't want to do anything if they don't have to, frustrated, you're trying to get a handle on things, but you just don't feel like you're getting there. Somebody in the middle, where there's probably improvements that could be made, but you have a pretty good grasp on things. Proactive means you're very active. You're doing education, you do a budget, you might even have a financial plan, you talk to your advisor. And last, which is kind of funny because I don't think anybody is here, including us, why am I even attending this webinar? I know everything. And unfortunately, since there's not that many, oh, B's here. Hi, B. You can let B talk too if you want.
I'll just say that because I'm a panelist, I can't participate, but I will just say personally, I'm in the middle, which, I feel hesitant to admit to as a financial advisor, but, financial advisors need help also with our own finances and to make our own plans. And sometimes you get wrapped up in helping other people with their plans and you're like, oh, wait, I gotta take care of my own business too, so.
Yeah, it's hard to follow your own advice sometimes.
Yeah. I think Danielle is talking, but she's muted, or at least I can't hear her.
Can you hear me now?
Oh yeah, there you are.
I think I'm having some issues with my microphone. I don't know what's going on.
Okay.
It could just be my USB plug. I don't know. The computer's getting old. I was going to say that I feel like I'm mostly proactive, except when it comes to trading. Like when we're doing all the adjustments in client portfolios, I'm like, oh yeah, I should work on my own portfolio. That's something I'm really bad at. All right, everybody else kind of feels
everyone's
like
in the middle.
That's good.
Yeah, there's always room for improvement, right?
Oh, Cornelius is here. We can give him the option to talk. For those of you who kind of jumped in a little bit late, we've given our attendees the option to just talk whenever they want to, because we have a smaller group today. So if you have questions or you want to talk about something, feel free to jump in, or you can raise your hand. There's a little button on your screen, or you can send a chat if you don't want to interrupt, but you have something you want to say. All right, so we're going to move on. For those of you who got in a little bit late, the first thing we were going to talk about is just sort of how emotions tend to guide a lot of our financial planning among our personal finances. And obviously you can't get rid of all emotion. That wouldn't make sense. Your financial plan is very much dependent on you, who you are as a person, what you like, what you don't like, what your goals are. So that's not something that should be completely ignored. But a question I'm getting an awful lot the last 2 to 3 years is, I really want to pay off my house. Can I pay off my house? And it doesn't start usually with, hey, this is my goal. Can you help me get there? I know, there's taxes. What should I do? It's, I want to pay off my house. I'm sick of paying this mortgage. It's clearly a very emotional thing for people. And I get it. It's a large debt. So we have this conversation. I have this conversation very regularly. And so I wanted to do an actual example with it, with numbers. And so I want to start with questions you should ask yourself, or the questions that I'm going to ask you, because these are the questions that I ask folks when they come to me and say, I want to pay off my house. The first question I always ask is, what's the interest rate on your mortgage? I looked at a mortgage statement the other day, and their interest rate was 2.75. I know interest rates are higher now, but a lot of people were lucky enough to refinance during the COVID debacle, where interest rates were super, super low. So that's a very important piece of information. The next is, what is your monthly payment? Are you actually having any trouble covering it? Like, is that the problem? Or are you just truly sick to death of looking at it? Then we have to say, okay, what are the tax consequences of a distribution from your retirement account? And when I say retirement account, we're usually talking about pre-tax accounts, traditional 401ks, traditional IRAs, mostly because that's where the bulk of a lot of people's wealth is. And the issue with taking money out of an IRA or a 401k that's traditional is that you've never paid taxes on it ever. So the IRS is going to tax all of it, and it's to be taxed as if it's earned income. The other one that I think a lot of people forget about is the future earnings on that distribution. So if you take money out of the account, yeah, you're going to lose that amount of money and you're going to pay taxes, but you're also losing the future earnings on that money. And that's a really important thing to consider as well. And lastly, usually where I land is, okay, I get it. You hate your mortgage. You want it paid off. Now, what is this really coming down to? And what's a good compromise? What's a way for us to make you feel like you're accomplishing something, but we're not like completely raiding a nest egg? That's incredibly important. And something I say all the time is, if you think that you're having a hard time now while you're working and earning money, then you have no idea what you're in for when you turn 65, 70, 80, and you cannot work. You can't make money anymore. So I always try to remind people of that you have a cash flow right now, and that's a very different situation than when you're retired. So if we move on to the next slide, I made up a couple here, Bob and Mary. They're 55. I often get questions like this, some between 50 and 60 years old, so although younger sometimes. So I made up a scenario that I felt like was sort of in the middle. They have a mortgage and principal and interest per month of $1,000, an interest rate of 4%. They want to pay off a balance of $100,000, and they have 10 years left. And they're saying, I don't want to pay off my house at 65. I just want to be done with this thing. So right now we're saying the value of the home is $300,000. It'll be worth $400,000 in 10 years when it's paid off. So there's not an issue of equity, right? These people have a lot of equity already in their home. And their budget savings is $120,000, meaning if they stop paying $1,000 a month for the next 10 years, they won't be spending $120,000. They are, but they're talking about rating their retirement account to get to it. So now let's look at the retirement account that they're talking about taking the money from. So right now it's worth $1 million. We're just going to use a conservative, normal, average annual earnings of 5% on that account. This particular client is looking at a penalty of 10% on anything distributed from that IRA because they are under the age of 59 and a half, and they're in the 22% bracket. In order to pay off the house with $100,000 and cover the taxes, they actually need to distribute $147,059. So on the next slide, we're going to talk about some of the other important items. And one of those is the earnings. I talked about what would the earnings be. So I just plugged in a very simple chart here. If the account earned 5% every single year and they didn't add anything to it, what would the earnings be on that amount of money, that $147,000 over 20 years? And the answer is $252,661. That's just the earnings. So if you add the federal income tax owed, the cost of the distribution is just shy of $300,000. And they would be saving interest over 10 years of a whopping $21,500. So on the next slide, just kind of round it all out. Okay, so the grand total of paying off their $100,000 mortgage early so they could stop paying $2,000 a month or $1,000 a month, which they had in earnings, The total cost is $278,220. I don't know about you, but that is a lot of money. So alternatives, the next thing that I usually talk to clients about, I've actually had clients text me and go, can I pay off my house? And I just go, no, like, I just won't entertain it, because they're just shooting me a text at like 5 o'clock at night. They've clearly had a bad day. It's just something that's bothering them and they want to address it. So I usually just say no. And if they want to discuss it, then we have a more detailed conversation. And one of those is, let's talk about it. Let's actually have a conversation. The other one I tell people is, if you have the room in your budget, just increase your monthly mortgage payment. If that will make you feel better and it will help you pay it off faster, by all means, do that. Refinance. What's your interest rate? What are the current interest rates? Does it make sense for you to refinance and lower the amount of money that you're paying in interest, which increases the amount you're paying in principal? The other point is that you probably have much more important debts to worry about. Credit card debts, for instance, are the big one. Medical expenses, anything like that. The other is simply, you might just be under a lot of stress. Maybe you just need to take a vacation. The cost of a vacation is a heck of a lot cheaper than paying off your mortgage with your retirement account. So I have a lot of these conversations with clients about just trying to stay calm and stay mentally focused on the big picture, the long-term plan. And so there's a lot of, I guess, kind of psychological, financial discussions that go on with these situations. That's where I'm at on that. Anybody have any comments or questions, or do you guys have anything to say? All right. With that, we'll move
I
on.
was on mute. I was just gonna make another point, is that I do think that a lot of people want to get their mortgage paid off before they retire, because they think that that's going to help their cash flow in retirement, because they're not going to have to make that monthly payment. And I think the numbers you just worked through showed how that's really not the case. And you're going to need that cash, right, to pay your property tax bill or to pay for home maintenance, right, when you're retired. Your housing expenses don't go away, even if you pay off the house.
I know, for instance, I looked at a mortgage statement the other day, and they were like, I'd love to get rid of this mortgage payment. I was like, well, you're paying $2,000 a month, but $1,000 of that is property taxes and homeowners insurance. Like, that's not going away if you pay off your mortgage. Mm-hmm. The other point that's really, really important is, I don't think most people recognize the insane cost of healthcare as you get older, especially if you want to maintain a certain standard. A lot of people they think they want to spend down so that they don't have to give all their money to a nursing home, but that means that you are at the mercy of your family to take care of you, or at some Medicare, Medicaid-based facility. So, that money is important. You need it for your comfort, for your sanity, to help your family who may not be able to take care of you. And it's just, whenever I do financial plans and the software runs the cost of healthcare, it's pretty incredible. And just in current day, for instance, I've got a client who has a mother in a full nursing. I mean, she's in very bad shape. She's lived there now for at least 2 years, and it costs $80,000 a year. And she is running out of money in a year and a half. So these are real issues. They're incredibly expensive, and the mortgage is just not as important. Like Amanda said, it may not really be impacting your cash flow like you think it will. And let's have an actual conversation about it, including a budget and long-term. And that's what financial planning is about.
Great. So we'll continue on with financial planning and planning around feelings and behavioral finance. I'm going to talk about a few tools that might be helpful to take a different approach to looking at your finances, so you're not just looking at your bank statements or worrying about your debt amounts. But first, we are going to do another poll question, and I need to find out where it is. Come on, sorry. I had it open and now it's gone. All right, maybe we'll skip this question, but this is what it would be. Financial planning is the art of drafting a written plan that confirms your current assets, itemizes savings and spending habits, outlines your future needs, and creates a path to your overall goal. So which one of the following do you employ in your planning process? It's It's writing a personal budget, routine reviews of personal savings and spending habits, a written financial plan for a specific goal like retirement, or regular conversations with my financial advisor. And I guess it could be multiple. So just something to think about. So this first tool I'm going to talk about is about reframing your questions. So as Danielle touched on, these are some very broad questions that can maybe be very overwhelming if it's something you're thinking about. You know, you're trying to sleep at night and you're like, how do I pay off my debt? And these are all good questions, but like I said, they're very broad. So another way to kind of bring things more into focus and help work with making yourself feel a little less overwhelmed, a little less stressed, is to just reframe your question to something a little more specific and actionable. So instead of, am I saving enough to retire? It turns into something like, can I cut some spending to contribute more to my 401k? So unfortunately, the answer is probably you are not saving enough to retire. The statistics are that most Americans are not saving enough to retire. So this is one way you can start to think about how you can, you know, get down to the, am I saving enough to retire? How much do I actually need to retire question? Instead of how do I pay off debt, maybe you can look into how much interest you're paying each month if you don't know that answer. Instead of how much should I contribute to my child's education, which accounts am I contributing to each month? So sit down and maybe you can move things around. Same thing with, can I buy a new car this year? That's another thing that you would need to look at your budget and maybe decide how much can I contribute this month. So all those answers can be found in your budget. Budgeting is super important. We talk about this all the time. Some people have a written budget, some people use a spreadsheet or a fancy app, some people have it in their head, or they're just like, well, I spent less than I made this month, so I'm good. But you really need to drill down to get those answers, because if we go back to that first slide and you come to your financial advisor and say, do I have enough money to retire? The first question, as Danielle already talked about, is, well, how much are you spending each month? And how much are you going to need to spend each month in retirement? So, and it's a lot harder when you're not making money or when you don't have that job income coming in. So a lot of these things are fairly simple, especially if you have a W-2 job. A lot of the monthly expenses are set, like mortgage, student loan payments, any kind of subscriptions are usually a set amount. So start with those. Sorry, we have a visitor. And don't forget to budget in fun. Maybe you have an event coming up and you need to buy a new outfit or something. We still want you to enjoy your life, so don't forget about those things. And then instead of putting retirement savings or other kind of vacation funds and other things as expenses, I would put them in a separate category called your contributions, so that it's kind of like, where am I putting the money that's left over? I'm putting them into these buckets, and it's a little easier to visualize. The final tool I'm going to talk about, because I'm a CPA, is a thing called a balance sheet. We don't really use it a lot in personal finance. It's more of something that you'll see in businesses. But I think it could be really helpful every once in a while to look at your assets versus your liabilities. It's not something I would suggest doing all the time, maybe once in a while, maybe even once a year, or when you are trying to make a larger financial decision. So assets are things that you own that have value. So your home, your car, and then any of your investment accounts and retirement accounts. Liabilities are your mortgage, any loans, and any debt you have. So basically you subtract the liabilities from the assets and you're left with your net worth. I would not focus too much on your net worth. That number is not super important. We kind of just want to make sure it's positive. That would be a first goal, I suppose. If it's negative, we've got some work to do. Okay, so here is an example of two balance sheets. The person on the left has a home value of $350, car value of $10,000, 401k, Roth IRA, and savings account make up the rest of their savings, with total assets of $565,000. The liabilities include mortgage, car loan, student debt, and they've done some work so they don't have any credit card debt at the moment. And this brings them to a net worth of $422,000. Again, that's not super important, and you'll see why on the next example. But let's go back to that example that Danielle gave in the first section. This is a lot more simple, but it can kind of help you visualize what's going on. So this person realized they had 125 in their 401k and their mortgage is 125. So they're like, okay, I'm sick of this mortgage. I want to get rid of it. I'm going to just completely liquidate my 401k to pay my mortgage. Obviously, we wouldn't necessarily recommend doing that. And there's a lot of other issues and taxes and everything that comes into play. But just to keep things simple, if we jump to the right column, so you'll see that the liabilities have decreased significantly, which is great, but the assets have also significantly decreased. And it's important to note what type of asset decreased. The 401k, Roth IRA savings account, any of your investment accounts are a lot more liquid than your home or your car. I mean, your car value is probably only going to decrease unless you own some kind of crazy antique or, one of a kind vehicle. And your home value, I mean, we've seen over the past 20 years that's gone up and down. The housing market has been very volatile. And if you need cash right away, it's kind of hard to just turn around and sell your home. It's just one single asset. So it would be ideal to have a higher amount of those liquid assets that are invested in underlying investments. Although the market's been volatile over the past few years, you have the ability to have that liquidity and buy and sell things as the market moves in order to they have more of a potential, we have more potential to grow than something like a car or a house.
I was going to jump in and say the same thing, that the assets on the top have the ability to get bigger and bigger and bigger, and the liabilities will be spent down over time, and they will go up if your interest rate is insane, but there's a huge difference there. There's that age-old saying, it takes money to make money. And that's exactly what she's showing here. Mm-hmm. Hey, can you turn Rich on? He's here and he can talk if he wants to once we give him microphone access.
There you go.
Thank you. Mm-hmm. Hey, Rich.
Okay, so if at the bottom line, the net worth is the same. So that's why I wouldn't really focus on that number, because it's a little bit more about which assets you have there. Oh, we lost Amanda. Hopefully she'll get back on. And yeah, so this last slide, I mean, it comes down to personal finance is personal. It's all about you. Think of your financial advisor as someone on your team. We are going to help you meet your goals, but you have to be the one that has those goals and has broken it down and find out what matters to you. So if you're having those moments of overwhelm and you can't sleep at night, on this pie, I've put other projects. I think financial planning might fall into that for a lot of people, or possibly family or self-care. It could be part of that. But we all have a lot going on, and it's important to make time to see what you want your retirement to look like and be able to worry less and enjoy your life more. So I think that's all for me.
I was going to jump in and say, yes. We say this all the time, but almost all the time when a client calls me, the first thing they say is, I'm sorry to bother you. And that's truly what we're here for. You're never bothering us. We want to help you, especially if you're stressed out. So even if you're just like, you have a bad night, you can't go to sleep, and in the morning you're like, I need to talk to somebody, just let us know. We'll be happy to make an appointment with you and just talk. I mean, there's been times where I've just talked to a client for an hour and we don't really necessarily accomplish anything. The whole goal is to just help them feel better. And sometimes that's all they need.
Okay, I got the poll questions working again. I'm going to back up and then get this over to Amanda.
Okay, thanks, Emily. I just got booted off the webinar, so I sort of missed the tail end of what you were saying, but I got back on my hotspot, so hopefully I stay on. So this was a poll question. I just wanted to get an idea of how everyone was feeling last year. If you remember, the market was down significantly, the stock market, as was the bond market. And international markets were down as well, although probably not down as much. And that was causing a lot of fear. And so I know some of you on this call, but not everyone. And so I know some people were pretty spooked by that. And then now I feel like a lot of things have calmed down a lot. I'm not getting as many phone calls or concerns from clients about what's going on with the markets like we were last year. So my general sense is that people are feeling better, but I'd love to hear what you think. So personally, I'll say I am probably number 4. Although I lean a little bit number 3, because I'm always a little bit like, you know, what's going to happen next? We don't know. There's uncertainty. So
I don't think I've been spooked since 2008.
since 2008. Okay. Yeah.
Worst year ever. Even when COVID happened, I was like, oh, well, this is happening.
Yeah. Yeah. Okay. So Emily just posted the poll results. I don't know if the attendees can see the results or not. I can see them. And so most people were spooked before and are now fine. So that's sort of what I expected. But if we look in the next slide, I just grabbed some headlines. I mean, this is the kind of stuff we were seeing. I love the markets in turmoil from CNBC. The bond market, worst market since 1842. I mean, that's bad, you know. Lots of red, lots of pictures of bears. You know, Putin, the evil, you know, dictator from Russia is causing all this havoc. You know, what's going to happen? There's a lot of fear and a lot of uncertainty about that, on how that was going to play out. And I think, you know, in the stock market, we always see downturns and they happen all the time. But I think last year it was particularly unsettling because, you know, it was the bond market going down as well. And also tech stocks, which had been pretty reliable and big growth stocks in a lot of people's accounts, those were particularly hard hit. And so that freaked people out a little bit more than the usual. But thankfully, if we look at the next slide, we're into summer 2023. And I put on the right, you could see this Twitter screenshot from Charlie Bilello. I thought I put this in one of our monthly emails, but I really liked it, so I put it here again. And so he's tracking whenever CNBC airs its markets in turmoil special report, there is a 100% chance, like since 2010, that the S&P 500 will receive positive returns within a year. And so of all the indicators of what's going to happen in the stock market, there is like none that are 100% on the money every time, but this one seems to be particularly good to track what's going to happen in the stock market. And so, you know, it's one thing to sort of, you know, joke about it or say, well, you know, CNBC, they're sort of extreme and they just want to get ratings, but those, you know, they're expressing a sentiment, you know, they do stir it up a little, but I mean, people are feeling it. You check your account and you see it's down, you know, and that causes emotional reaction, even if you're trying to say, I don't really care. I mean, it does bring about emotions in people. And when those emotions or fear takes over, that can lead to some questionable decision-making at times. So on the next slide, you know, I wanted to show the impact of that. If you do say, okay, I'm spooked by the stock market, I'm going to take all my money out or stop putting money in, you're going to miss, you know, when the stock market goes back up. So this is data from Northern Trust where they ran it back to 1979. So this is like a 43 years investing. And if you invested $10,000 and you just left it in the S&P 500, that $10,000 would turn into $750,000, which is, that's great, right? But if you got spooked and you missed only 5 days of the best returns in the stock market, your returns are almost cut in half. And if you miss the 10 best days, you are in half. And so if you do make these decisions based on that fear, or you let it spook you to the point where it's impacting your investment decisions, then this is real consequences to your investing account. Okay, and so this so now, now this is the fear index, or the VIX, and so it's just a measure of volatility in the S&P 500. It's sort of a shorthand to see sort of how investors are feeling out there, and it has gone down more than 45% since last May. So which is good. So now we're sort of the market's still a little volatile, but the fear has gone down significantly since last year. And so when we are in a calmer period in the market, I think it's a good time to make an assessment of things like, how did I do in the downturn in 22? How did that make me feel? Did I make any decisions that could have impacted my account? What can I do differently next time? And Danielle and Emily touched on financial planning and how important it is. And so that can really help you if you have a plan in place, to just say, okay, the market is sliding, I'm freaking out, what am I going to do? Okay, just go back to my plan, just stick with the plan. That kind of having that in place can really help prevent some emotional decision making. Can we go to the next slide? Okay, yeah. And so then I want to pivot a little bit to the bond market. Here I showed this slide at our last presentation, but it continues to be true. We've seen the Fed raise interest rates, and those interest rates are now, we're seeing them in money market accounts and bonds and CDs, and you are getting money in the bond market now. And then if we look at the next slide, we can see money market funds. Oh, what's that?
So I feel like we need to have a moment of silence and just enjoy this. Like, it's such a big deal. We haven't been making money in cash or cash-like assets in so long. It's very exciting.
Yes. And this is my summer vibes video. You can just put your money in a money market, and which a lot of people have been doing. We've been seeing record inflows into money market funds. And that's great. That's a great place for your cash, because if you remember last year, you were not getting that for your cash. You were lucky if you got, you're getting less than 1%, if that. So, but if we look at the next slide, money markets are paying more than 5%. This is Gonzo getting hit by a piano, right? And so I wanted to take a moment and explain reinvestment risk, because this is a question I'm getting from a lot of clients and prospective clients. And why should I bother taking the risk of investing in the stock market if I can just get this great money market rate? And yes, it's great. It's appealing. There is risk to it, but it's not a high risk, relative to the stock market. But many people are, fail to appreciate the risk of reinvestment risk. And so I put this Gonzo, there is the piano hanging over your head, and, just because you don't see it doesn't mean it's not there. So now that I'm explaining this to you, hopefully, you can step away from underneath the piano. But okay, so then, just to give a quick background on bonds, you saw the oh, go ahead.
Define reinvestment risk just a little bit.
Yeah. I'm going to get to that after I talk about this just a little bit. So in the bond market, right? Last year, the bond market fell significantly, right? And that's because interest rates are rising. The Fed increased the rates at record rates. So you can see the bond market works like a seesaw. So as the interest rates go up, the bond prices are going down. And that's what we saw last year. And then you can see at the fulcrum of the seesaw, that's a shorter duration bond is towards the middle, a longer duration or a longer maturity in a bond is out at the outer edge. And so as the interest rates go up, the bond prices fall, and that effect is amplified the further out you are in terms of bond maturity or bond duration. And so that's sort of the typical thing that happens in a bond market. It is a little bit skewed now because the yield curve is inverted. And so on the shorter end of the bond duration spectrum is paying a higher interest rate now than longer out. But the yield curve is not going to stay inverted for forever. Eventually, it's going to hopefully get back into place where the shorter end will pay less than the longer end. So Emily, can we go the next one? Okay. So this is what we're talking about when I mentioned reinvestment risk earlier. So this is just looking back at 2007, the Great Recession. Danielle's last time she felt fear of the markets. So here you could see the interest rates by the Fed is this purple line. So that was elevated a little more than 5%. And then after the financial crisis, the Fed started cutting the rates. So that's, you can see the purple line falling off there over a period of a couple years. They cut the rates. Then we can see here this blue line. This is the short-term treasuries. So they're at the middle of the fulcrum. So as the Fed cut the rates, that seesaw didn't go up as much because it's just a little bit off the edge there, right? But this orange line, this is an ETF of 20-year and longer treasuries. So they're on the outside of that seesaw at the edge. So when they cut the rates, those prices start going up. And so you can see that reflected. This is showing total returns. So in a bond, the return of the bond is a combination of the price of the bond plus the coupon. So here we're seeing the total return. So the price going up, even though the interest rate is going down, the Fed is cutting rates. And so that is where you want to be. You want to be at the end of the seesaw. And once the Fed starts cutting rates, if you are not in the bond market and you're in a money market instead, you're not capturing that tailwind that's coming for the bond prices to go up. You're going to get interest rate going down in your money market, and you're not going to be capturing the bond price going up. So that's essentially reinvestment risk. And Danielle touched on this earlier, but these are examples of the real risks of not appreciating the bond market and stock market and the benefits they can have, because a lot of people need the growth in their portfolio. And if they get spooked or don't get in on it, they're going to miss out. And so, I mean, the trope about seniors eating cat food is sad and awful, but it's actually a thing that happens. I don't want any of you listening to this call to end up like this. We also see a lot of people, middle-aged people, who are taking care of parents who are running low on money, and then they're getting squeezed trying to save for their own retirement or take care of their own children. And then this chart is a little bit scary, but this, inflation has been going up, and this is, impacting the inflation rates on home health aides. They're making more than ever. So we want to be investing. We would like to make at least inflation and preferably more. And one of the best ways to do that is to keep your money invested, because typically money markets and CDs are not going to get you to there. And then I don't want to end on this negative slide. So I found some stock photos of retirees, which I know this is really silly, but these people are a lot happier than the other people. So I'll leave it there.
What questions, any of our attendees have any questions or anything they want to talk about more, or any slides you want to go back to and look, or anything when you want to compound on? Also quiet. Nothing? We covered it all. We did such a good job. Nobody has anything to say.
Yeah,
Yes, go ahead.
I was just going to say, this is a little bit different of a webinar than we've done in the past. It's more like personal finance instead of market based. So
Yeah.
there's a lot of takeaways, I think.
I think there is in the Q&A section, Rich asked, I have heard some about I bonds. Do you recommend these? Do you want to take that, Danielle? Because I think you have some experience with I bonds.
Yeah, so I-bonds, last year I-bonds were kind of amazing. I-bonds are treasury bonds issued by the US Treasury. You can buy them directly from the Treasury website. You can buy up to $10,000 per person in I-bonds per year, and it's a variable interest rate. So the difference between an I-bond and inflation linked treasury versus a regular treasury is that it's just like it said, as inflation goes up, you can expect to have more income. And in the middle of 2022, the interest rate on I-bonds was 9.62. And so I was talking to people about that, at the time for specific reasons, not like, let's just dump a bunch of money in I-bonds. The example I can think of is I had a friend who had children in college, and I was like, hey, why don't you buy an I-bond? I mean, it's $1,000 in income in 1 year. Now they change that every quarter. It's dropped significantly. I looked at it the other day and I think it was down to like 4.625 or something. So there's pluses and minuses to them. You can buy them. Like I said, last year was a great time to get in, or the year before. You do have to hang on to them for a while. The interest stays in the bond. It isn't received until the bond is sold and the money is distributed. But one of the great things about I-bonds, if you have a kid in college, especially if they're in going to college soon, we have a lot of people who start Prop 29 plans, college savings plans for their kids when they're itty bitty, but sometimes they think about it later in life, or they just don't have the money for it until later. And they're like, I have like $20,000, what should I do with it? And I-bond would be great because all that money is going to continue to go. And if the money is spent on college expenses, it's not taxable. So in very specific instances, I think I-bonds make sense. We have the same issue with those as we do with like when Amanda was talking about money market funds. It's a variable rate. It's going to change. So for instance, if you buy treasury bonds directly, which we're doing for a lot right now, you can buy them out 3 years and lock in the current rate, which is very nice, for 3 more years versus like enjoy it for 3 months and then the Fed adjusts and you lose that really high interest rate. So like I said, in small instances and specific circumstances, I think that they make sense. Rich, let me know if that was helpful. B asks, if we have money sitting in an emergency fund, should we move it to a high rate interest bearing account instead of low bank savings account? Obviously, yeah. I mean, I think it makes sense to put money, even emergency funds, into something. I've had 3 clients just in the last 2 weeks, for whatever reason, suddenly have a bunch of cash. One was an inheritance, one was a home sale, and some other reasons. And they're older and they want to keep it safe, and they don't entirely know what they're going to use it for, but they may use it for something soon. I'm buying treasury bonds for them. 6-month treasury bond is paying 5%. So we drop it in there and leave it go. And then in 6 months, we'll see what they need to do with it. And if they don't need it, we'll reinvest it in something else. So there are lots of higher interest rate opportunities, as long as they're flexible and you can get out of it. If it's one of those high rate interest bearing accounts where you can't touch it for 6 to 12 months, then that makes me a little more nervous. But if it's something that you can liquidate upon whenever you need it, then sure, I think that makes perfect sense. One of our money market funds that we use at Schwab right now, I just had some clients roll over a significant amount of money out of some 401ks after they left their jobs, and I don't invest it all in one day. So I've invested some of it and I want to sit on it and think about it and see what the market does in the next week. And I parked it into Schwab's government money market fund, which is paying 5%. It probably won't be in there more than a week, but they'll get a 5% annualized rate on, their money for a week while I decide what I want to do with it. And then he says she's talking 3 to 10K more than that, I'd move it to retirement savings. Yeah, I still think as long as there's not a minimum and you can get to your cash from a high yield savings account, I think that makes perfect sense. Anything else? You guys can talk, I don't know if you've figured out how to do it, but you can talk. All right. Oh, wait, Rich said something else. Do you see any upside in commercial real estate yields? I don't work in commercial real estate. I know that, do you mean by like buying bonds that are issued by a city? I'm not sure what you're asking there.
Can you guys hear me?
Yeah.
Oh my goodness, I'm on. I was just kind of thinking about you know, like you see some of those fund names or like, you know, real estate fund from, you know, Schwab or whoever, right? Are you guys taking money out of those? I keep reading stuff about like, you know, office spaces, you're getting on these crazy like all-time highs. There's so much office space inventory. You know, personally, like my company is vacating some floors in our office. You know, it's like nobody's going downtown anymore. Everybody's working from home.
We've definitely moved away from real estate. It's not as big of a holding as it used to be in the portfolios. We also have infrastructure, which is not the same thing, but it's income producing. So we're talking about literally infrastructure, bridges, roads, things like that get built, and they issue bonds to help pay for them, or they bring in toll money or things like that. So there are other ways of kind of getting that income producing, cash flow based asset that's still considered an equity, but it's not a bond. Did that answer your question?
Yeah, no, I didn't realize there were I didn't realize there was a market for like bridges and infrastructure projects as well. I thought it was essentially like high rises and apartment buildings and condos and such.
Yeah, there's different sources of rental, you know, and those companies. I am curious. We probably need to talk to Cohen and Steers and just see. They've been our real estate investment fund manager for as long as I can remember, and I really should just, it's time, put a note on that and look that up and see what they're saying, because they do have other things, and one of those is storage facilities. And I don't know where you live, but they are building them like Dollar Generals around here. Every time I turn around, they're building a storage facility. So those are also a type of income producing real estate option. And, you know, they're getting creative. I was hearing someone just the other day was telling me that buildings kind of like one you were talking about, where they have all this open space, they're talking about renting it out for events or parties or weddings, or like they're just getting creative about what they can do with it. And I think that's really neat. I think it's one of the unique things about the people in our country. Say what you will about Americans, we come up with find ways to kind of make lemonade out of things, and I'm encouraged by that. I'm kind of excited to see where that will go. Anything else? Leslie
Yeah,
doesn't
I
have.
would just say if anybody has any questions, they prefer to discuss one-on-one, just feel free to reach out and do so.
Yeah. So do we have any other slides here? Oh,
Now we're done.
our
Yeah,
info.
there's our reach out slide, our
Yeah.
contact information if you don't have it. So
Let me go back. Here we go.
Oh, there it is. Yeah, I think you all know how to reach us via email, text, phone, however you want to get us. Yeah. All right.
okay.
Well, thank you, everybody. It was good.
Thanks,
Good to
everyone.
hear from you, and thanks for your questions. And again, once this gets all cleaned up and put on our website, feel free to share it with the folks or anybody who couldn't be here. I think that it's helpful information for anyone, which, like Emily said in the beginning, it's just sort of a really good general broad-based conversation about these sorts of things.
All right.
Okay. See you all soon.
All right. Thanks, everybody.
Thank you.
You're welcome. Bye, B. Bye,
Bye.
Rich. Bye, team.